Let me tell you something that most people outside this industry do not fully appreciate. When the lights go down in a Broadway theater and the overture begins, you are not just watching a work of art. You are watching a multi-million-dollar business operate in real time. Every note the orchestra plays, every costume change, every spotlight that follows an actor across the stage, all of it is being paid for, right now, by the tickets in the hands of the audience. A major Broadway musical can cost $800,000 to over $1 million per week just to keep its doors open. Not to make a profit, just to break even. That is the reality of this industry. And yet, despite those numbers, despite the fact that roughly 80% of Broadway shows never return their investment to their investors, people keep making them. Producers keep raising capital, investors keep writing checks, writers keep writing, and audiences keep coming. Why? Because when it works, when art and commerce align, there is nothing like it in the world. I am Sue Gilad, and this is Curtain Call Conversations. Today, we are going to talk about money. I know, not the most romantic topic for a podcast about Broadway. But here's what I have learned in more than 2 decades as a producer. You cannot separate the art from the commerce. They are not opposing forces, they are dance partners. And understanding how they move together, how a show is financed, how it generates revenue, how producers balance artistic integrity with commercial reality, is essential to understanding why Broadway exists at all. In this episode, I am going to demystify the business of Broadway. I will explain how shows are financed, how investors evaluate opportunities, and how the economics work from capitalization through recoupment and beyond. I will discuss revenue streams that extend far beyond ticket sales: touring, licensing, merchandise, international productions, streaming, and film adaptations. And I will share what I have learned from my own experience as part of the producing team of The Outsiders and co-producing shows like Moulin Rouge, the musical, about navigating the intersection of creativity and capitalism. Because here is the truth. Every great Broadway show is simultaneously a profound artistic achievement and a functioning business. And the producers who succeed in this industry are the ones who understand both sides of that equation. Let us start with the number that defines everything else: capitalization. This is the total amount of money required to get a show from its final development stage to opening night on Broadway. It covers everything: sets, costumes, lighting, sound, marketing, rehearsal salaries, theater renovation, advertising, and a reserve fund for unexpected expenses. For a new Broadway musical in 2025, capitalization typically ranges from $17 million to $25 million. Some shows cost more. The 2024 revival of Cabaret at the August Wilson Theater was capitalized at $26 million, largely because the production transformed the entire theater into a Weimar-era nightclub. Death Becomes Her, which opened in 2024, raised $31.5 million, making it the most expensive new production in 5 years. Moulin Rouge, the musical, which I co-produced, was capitalized at $28 million. For plays, the numbers are smaller, but still substantial: $3 to $9 million, depending on the scale of the production. Now, where does that money come from? The answer is investors, private individuals, and sometimes institutional funds who put their capital at risk in exchange for a share of the production's profits. The legal structure is almost always a limited liability company or a limited partnership. Each show is its own separate entity. The producer serves as the managing member or general partner. The investors are limited partners or members. And here is the critical detail that every potential investor must understand. You can lose everything. Unlike stocks or real estate, where there is usually some residual value even in a downturn, a Broadway investment can go to zero. If a show closes before it recoups its capitalization, investors receive nothing back. There is typically little or no legal recourse. The minimum investment varies by production. Some accept as little as $5,000, though $50,000 is more typical for major musicals. And the terms are straightforward. 100% of the production's net profits go to investors until the capitalization is fully returned. After that, after recoupment, profits are typically split 50-50 between the investors and the producers. So let me put this in concrete terms. The Outsiders, of which I am part of the producing team, was capitalized at $22 million. That means $22 million had to be raised from investors before a single ticket was sold on Broadway. Every dollar of profit the show generated went back to those investors until that $22 million was returned. Only after that threshold was crossed did the producers begin to participate in the profits. The Outsiders recouped its entire $22 million capitalization in the week ending December 28, 2025, approximately 20 months after opening night. In an industry where 80% of shows never recoup at all, that is a remarkable achievement. The show has played over 746 performances, been seen by more than 770,000 audience members from all 50 states and over 75 countries, and became the first show in the history of the Bernard B. Jacobs Theater to surpass $2 million in gross revenue in a single week. Moulin Rouge, the musical, which I co-produced, recouped its $28 million capitalization in late 2022, roughly 3 years after opening. As of February 2026, the Broadway production alone had been seen by 2.6 million people and sold $348 million worth of tickets over its nearly 7-year run. That is the kind of return that makes investors very happy. But I want to be honest with you. These are success stories. They are not the norm. The norm, statistically, is that your show does not recoup. It has been calculated that the recoupment rate for Broadway musicals over the last 5 years is 20.45%. That means roughly 1 in 5 musicals returns its investment. That number has remained remarkably consistent since the 1960s. It has not changed in 60 years. Once a show opens, a new financial reality takes over. Every single week, the production must generate enough revenue to cover its operating expenses, what the industry calls the nut. If the box office falls below the nut for too many consecutive weeks, the show closes. It is that simple. The Broadway Journal reported in 2023 that joining the $1 Million Club at the Broadway box office used to be a matter of prestige. Today, it is often a requirement for a show's survival. That single sentence captures the transformation of Broadway economics over the past 2 decades. Let me give you some specific numbers. In 2024, the weekly operating costs, the nut, for major Broadway musicals looked like this. Cabaret needed to gross $1.16 million per week just to break even. Water for Elephants needed $960,000. Back to the Future needed $980,000. Even Merrily We Roll Along, a relatively intimate show with a small cast, had a weekly nut of approximately $950,000. Where does all that money go? The weekly budget breaks down into several major categories. First, there are fixed costs: theater rent, insurance, company management, stage management, and administrative overhead. Then there are personnel costs: salaries for the cast, the orchestra, the crew, wardrobe, hair, and makeup departments. Then there are variable costs, most significantly royalties. the percentage of gross revenue paid to the show's authors, director, choreographer, and other creative stakeholders. Royalties typically consume around 40% of weekly profits. And finally, there is marketing and advertising, the constant effort to keep seats filled. For a show like Moulin Rouge, with its massive set, large cast, elaborate costumes, and full orchestra, the weekly operating costs were well over $1 million. For a show like Gutenberg the Musical, which has 2 stars, 2 understudies, 3 musicians, and a minimal set, the weekly break-even was $638,000. The economics of scale matter enormously, and here is what makes this particularly challenging in the current environment. Production costs have been increasing by approximately 5% annually, while average ticket prices have actually decreased. In the 2023-24 season, the average Broadway ticket cost $125, down from $128 in 2018-19. Costs are rising. Revenue per ticket is falling. That squeeze is real, and it is putting enormous pressure on producers. The response has been multifaceted. Dynamic pricing, where ticket prices fluctuate based on demand, similar to airline tickets, has become standard practice. Premium tickets for the most desirable seats at the most popular shows can reach $500, $800, even $1,500. At the same time, lottery programs and rush tickets provide access at $30 to $40, ensuring that Broadway remains accessible to audiences who cannot afford premium prices. But dynamic pricing alone cannot solve the fundamental challenge. When your weekly nut is $1 million and your theater holds 1,200 to 1,500 seats, you need to fill those seats at high prices, consistently, 8 times a week, 52 weeks a year. There is no margin for a bad month. There is no safety net. Every week is a new test. Here is something that sophisticated Broadway investors understand, but casual observers often miss. The Broadway run is not the whole story. It is the beginning of the story. The real financial model of a successful Broadway show is what the industry calls a waterfall, a cascading series of revenue streams that can generate income for years, even decades, after the Broadway production closes. Let me walk you through each of these streams. The first and most significant post-Broadway revenue stream is touring. A national tour takes the show on the road, playing in cities across the country and eventually the world, reaching audiences who cannot or will not travel to New York. Tours have their own capitalization, their own cast, their own production costs. But they also have their own revenue. The Outsiders North American Tour, of which I am part of the producing team, launched on September 17, 2025, at Shea's Buffalo Theater. It officially recouped its $11 million capitalization after just 29 weeks on the road. 29 weeks! The tour has been seen by more than 548,000 patrons in 23 cities across North America, with dates announced through December 2027. And future productions are planned for London's West End, Asia, and Australia. Moulin Rouge, the musical's first national tour, launched in March 2022 and played continuously across the United States for over 4 years. The show also has productions on London's West End and in other international markets. Each of these productions represents a separate revenue stream, separate capitalization, separate profits, all flowing from the same creative property. The second major revenue stream is cast albums. These recordings capture the score as performed by the original cast and allow fans to relive the experience or discover the show for the first time. In the streaming era, cast albums generate revenue through platforms like Spotify and Apple Music, and they serve a dual purpose. They are both a revenue source and a marketing tool. A cast album that goes viral on streaming platforms can drive ticket sales for years. The Outsiders is a perfect example. In July of 2026, the show's Grammy-nominated original Broadway cast recording surpassed 100 million streams worldwide across all digital platforms, and it continues to be streamed more than 100,000 times every single day. Every one of those streams is revenue, and every one of those streams is marketing, an invitation to experience the show live. Smart producers think beyond the standard cast album. Instrumental versions for karaoke, tracks designed for school and community theaters that may not have full orchestras, deluxe editions with bonus content. Every variation extends the revenue life of the music. The third revenue stream, and one that can generate income for decades, is licensing. Once a show completes its Broadway run, the rights to perform it can be licensed to regional theaters, community theaters, schools, and amateur groups around the world. Licensing houses like Music Theatre International, Concord Theatricals, and Theatrical Rights Worldwide manage these rights and collect fees that typically range from $3,000 to $10,000 or more per production run for amateur groups, and significantly higher for professional regional theaters. Producers typically receive 30 to 40% of licensing revenue. And here is what makes licensing so powerful. It is essentially passive income. Once the show exists and the licensing materials are prepared, revenue flows in year after year as thousands of productions are mounted around the world. A show like The Lion King, which has been licensed continuously since the late 1990s, has generated billions in total revenue across all platforms: Broadway, touring, international, licensing, merchandise, and film. The fourth revenue stream is one that has exploded in recent years: film and streaming adaptations. Disney purchased the rights to film Hamilton for $75 million in 2020. The resulting film, released on Disney Plus, did not diminish demand for live tickets. As creator Lin-Manuel Miranda noted, it amplified demand. The Wicked film adaptation grossed over $525 million worldwide by early 2026. These are not small numbers. They represent an entirely new economic model for Broadway properties. Live captures, professional recordings of stage productions, represent a related but distinct opportunity. They can be distributed through streaming platforms, reaching global audiences who may never visit New York. And they serve as marketing tools that enhance the licensing value of the show by giving regional and amateur producers a visual reference for what a fully realized production looks like. And then there are the ancillary streams: merchandise, sponsorships, documentaries, and branded partnerships. Merchandise, from t-shirts and programs to original cast recordings and branded accessories, provides incremental revenue at every performance. When a show closes, memorabilia from the production, set pieces, costumes, design sketches, can be sold to collectors. Sponsorships and brand partnerships provide financial support in exchange for advertising and promotional opportunities. The point is this: a successful Broadway show is not a single product. It is a platform, a brand, an intellectual property that can be monetized across dozens of channels over decades. The Broadway run is the proof of concept, the demonstration that the material works. Everything that follows is the harvest. I want to pause here and talk about something that gets lost in discussions of budgets and box office numbers: the human dimension of Broadway economics. Because behind every dollar figure is a person earning a living, a family being supported, a career being built. The Broadway industry supports over 96,000 jobs in New York City and contributes $14.7 billion to the city's economy. That is not just actors and directors. That is stagehands and electricians, costume designers and wig makers, box office treasurers and house managers, marketing executives and press agents, accountants and lawyers, carpenters and painters, musicians and music directors, ushers and merchandise sellers. A single Broadway production employs, on average, at least 386 individuals per performance, from the actors on stage, to the crew backstage, to the front-of-house staff, to the administrative team that keeps the business running. Multiply that by the roughly 30 to 40 shows running on Broadway at any given time, and you begin to understand the scale of this industry as an employer. The people who work on Broadway are represented by some of the strongest unions in the country. Actors Equity Association represents more than 51,000 professional actors and stage managers. Under the new Broadway production contract approved in October 2025, the minimum weekly salary for a Broadway performer rose from $2,638 to $2,717, with 3% annual increases built in. IATSE represents the stagehands, electricians, carpenters, props masters, and wardrobe, hair, and makeup departments. Local 802 of the American Federation of Musicians represents the orchestras. These are middle-class jobs in one of the most expensive cities in the world, and they exist because producers raise capital, take risks, and keep shows running. Every time a show closes prematurely, every time a production fails to recoup, it is not just investors who lose. It is the hundreds of people who lose their employment. The ripple effects extend through the entire ecosystem: the restaurants near the theaters, the hotels that house tourists, the taxi drivers and subway systems that transport audiences. This is why the economics of Broadway matter, not as an abstract exercise in finance, but as the foundation that supports an entire community of artists and craftspeople. When I think about the financial performance of a show I have produced, I am not just thinking about investor returns. I am thinking about the hundreds of families whose livelihoods depend on that show running as long as possible. Now we arrive at the question that defines the life of every Broadway producer. How do you balance artistic integrity with commercial reality? This is not an abstract philosophical question. It is a daily, operational challenge. Every decision a producer makes, from which shows to develop, to which creative teams to hire, to how much to spend on marketing, to when to close a show that is losing money, sits at the intersection of art and commerce. And the tension between those two forces is constant. Let me give you some examples of how this tension manifests. The first is the question of source material. Research shows that 82% of new musicals on Broadway over the past 30 years have been adaptations of films, novels, albums, or other existing properties. The average run of an adaptation is 644 performances. Why? Because adaptations come with built-in audience awareness. People already know and love the source material. That reduces marketing costs and increases the likelihood of commercial success. But does that mean original musicals are dead? Absolutely not. Some of the most successful shows in Broadway history, Hamilton, Dear Evan Hansen, The Book of Mormon, were entirely original. They had no built-in audience. They succeeded purely on the strength of their artistry. But they are the exceptions, not the rule. And a producer must weigh the artistic excitement of an original property against the commercial safety of an adaptation. The second tension point is star casting. The 2024-25 Broadway season was driven in part by Hollywood stars, actors whose names sell tickets regardless of the show. Star casting is commercially powerful. A recognizable name can add millions to the box office. But it also creates challenges. Stars have limited availability, their salaries are higher, and their presence can sometimes overshadow the material itself. The third tension point is scale. Audiences increasingly expect spectacle, immersive environments, cutting-edge technology, elaborate sets and costumes. But spectacle costs money. The more spectacular the production, the higher the capitalization, the higher the weekly nut, and the longer it takes to recoup. A show like Moulin Rouge, with its completely transformed theater, its massive cast, its hundreds of costumes, cost $28 million to produce. A show like Gutenberg the musical, 2 actors, 3 musicians, minimal set, cost a fraction of that. Both can be artistically excellent, but their financial risk profiles are completely different. So how does a producer navigate these tensions? I can only speak from my own experience, and what I have learned is this. The best commercial decisions are usually the best artistic decisions. They are not in conflict, they are aligned. When I look at The Outsiders, of which I am part of the producing team, I see a show that succeeded both artistically and commercially because it made bold, creative choices that audiences responded to. The decision to stage the Rumble in real rain with no music. The decision to use a movement vocabulary that was unlike anything else on Broadway. The decision to cast young, relatively unknown actors rather than stars. These were artistic choices, but they were also commercial choices, because they made the show distinctive, talked about, and impossible to replicate on a screen. They gave audiences a reason to buy a ticket. The show won 4 Tony Awards, including Best Musical. It recouped its $22 million investment. Its tour recouped in 29 weeks. Productions are planned for the West End, Asia, and Australia. That is what happens when art and commerce are aligned, when the creative choices that make a show artistically distinctive are the same choices that make it commercially successful. The economics of Broadway are not static. They are evolving rapidly, driven by technology, changing audience behavior, and the aftershocks of the COVID-19 pandemic. The pandemic was catastrophic for Broadway. When theaters shut down in March 2020, the industry lost over $1 billion in gross revenue, a 55% decrease from the 2018 to 19 season. 96,000 jobs were affected. For 18 months, Broadway was dark, and the recovery has been gradual. By the 2022 to 23 season, box office revenue was still down 27% from pre-pandemic levels. But here is the remarkable thing. Broadway came back. The 2024 to 25 season set an all-time record, $1.89 billion in grosses and $14.7 million in total attendance. Both figures were the highest in Broadway history. The industry did not just recover, it surpassed its previous peak. How? Several factors converged. Tourism returned to New York City. Hollywood stars drew new audiences to the theater. Film adaptations, particularly Wicked, which grossed over $525 million worldwide, created renewed interest in the source material. And a new generation of theatergoers, many of whom discovered Broadway through social media and streaming, began buying tickets. But the challenges remain real. Production costs continue to rise at 5% annually. The $30 million musical is becoming the new norm. Only 3 of 46 new post-pandemic productions recouped their investment in the first few seasons after reopening. The financial environment for new shows is, as Deadline described it, increasingly dicey. And yet, the industry continues to innovate. New revenue models are emerging. Live captures and streaming deals offer global reach. Social media marketing can build awareness at a fraction of traditional advertising costs. Dynamic pricing captures maximum revenue from high-demand performances. And the licensing pipeline, the waterfall of revenue that flows from a successful Broadway run into tours, international productions, regional theater, schools, and amateur groups, remains as powerful as ever. The producers who will thrive in this new landscape are the ones who think of a Broadway show not as a single production, but as the launch of a brand, a property that can generate revenue across multiple platforms, in multiple markets, for multiple decades. The Broadway run is the beginning, not the end. I want to close this episode with some reflections on what I have learned about the relationship between art and commerce over my career. First, financial discipline enables artistic freedom. This sounds counterintuitive, but it is true. A show that is well capitalized, well managed, and financially sustainable gives its creative team the freedom to take risks. A show that is constantly on the verge of closing, that is losing money every week, creates an atmosphere of fear and compromise. The best creative work happens when the business side is solid enough to support bold artistic choices. Second, audiences are smarter than the market gives them credit for. The conventional wisdom says that audiences want safe, familiar entertainment, adaptations of beloved films, jukebox musicals built around hit songs, revivals of proven classics. And there is truth to that. But audiences also respond to originality, to boldness, to shows that offer something they have never experienced before. The Outsiders was not a safe bet. It was a novel adaptation with an unconventional score, unknown actors, and a staging concept that had never been attempted on Broadway. And audiences embraced it because it was genuine, because it was distinctive, because it offered something no other show could offer. Third, the long game matters more than opening night. In Broadway economics, the shows that generate the greatest total returns are not necessarily the ones with the biggest opening weekends. They are the ones that run for years, that tour for decades, that get licensed to thousands of schools and community theaters, that become part of the cultural fabric. The Phantom of the Opera ran for 35 years on Broadway. Wicked has been running for over 20 years. These shows did not just recoup, they generated returns that dwarfed their original investments many times over. Patience and sustainability matter more than flash. Fourth, every dollar spent on a Broadway show is a dollar invested in human beings. This is the thing that makes Broadway economics fundamentally different from most other industries. The money does not go into machines or algorithms or inventory. It goes into people, into their talent, their training, their craft, their livelihoods. When a show succeeds, hundreds of families benefit. When a show fails, hundreds of families are affected. That human dimension should never be forgotten in discussions of profit and loss. And fifth, the art is the business. I have heard people talk about art and commerce as if they are opposing forces, as if you must choose one or the other. But in my experience, the most commercially successful shows are almost always the most artistically accomplished. The shows that win Tony Awards tend to be the shows that recoup. The shows that audiences love tend to be the shows that run the longest. Art and commerce are not enemies. They are partners. And the producer's job is to ensure that partnership thrives. Thank you for joining me for this look behind the financial curtain of Broadway. I know that numbers and business structures are not as glamorous as standing ovations and Tony Awards, but they are the foundation that makes everything else possible. Without investors willing to take risks, without producers willing to manage those risks, without audiences willing to buy tickets, there is no Broadway. There is no art without the commerce that sustains it. And there is no commerce without the art that gives it meaning. The next time you sit in a Broadway theater, I hope you appreciate not just the artistry on stage, but the extraordinary financial ecosystem that made it possible. The investors who believed, the producers who managed, the hundreds of people whose livelihoods depend on that show running night after night, week after week. That is the real magic of Broadway. Not just that it creates beauty, but that it sustains it. I am Sue Gilad. This has been Curtain Call Conversations. Until next time, the show must go on.